Morning, everyone. My name's Richard. I head brand and content for Cube Wealth, and I'd like to welcome all of you to Cube's second Know Your Assets and Advisors session. I hope you and your families are doing well. And as always, I want to thank you for joining us on a Saturday morning. Let me start by telling those of you who are new to Cube that Cube Wealth is an investment app focused on busy professionals. This means you get curated investment options handpicked by expert advisors with a proven track record. The aim is to offer the kind of stress free and jargon free investment experience that we would want for ourselves and our families. At Cube, we help you invest and build a perfect portfolio. And by installing the Cube app, you've joined people from over 10 countries and 100 plus cities, which includes founders and working professionals from brands like Amazon, Google, Pass24, Swiggy, etc. Now, the goal of these Know Your Asset series is to help all of you learn about investment options offered on the Cube app so that you can make informed investment decisions. In today's session, we're going to talk about P2P by Faircent, focusing specifically on the SIGP schemes offered on the Cube app. To tell you more about this option, we have with us Vinay Mathews, the founder of Faircent, and Cube's head of business, Gaurav Gupta. We'll start with Vinay, who will tell you a little about Faircent and then cover the SIGP schemes in a little bit of a detail. After this, Gaurav will ask you questions, which will include, will ask questions, which will include those sent by some of you in advance. And lastly, we'll have an open Q&A session where you can send in your questions via chat in case we haven't already covered them during the session. So out of experience from our past sessions, I just want to say that if the questions are repetitive, we probably won't pick them up. So if you've joined in late or if you've joined in the middle, just want to let you know that a video recorded session will be available to you guys later on our YouTube channel, and we'll probably send it to you via email. So let's get started. Vinay, are you here?
Yes. Thank you
Over
very
to
much.
you, Vinay.
Good morning, everybody. I hope everybody is fine and keeping safe. It's been a rough last couple of months, so I think all of us should be thankful that we are all here, live and kicking. If anybody has had a bad past in the last 2 months, I think my heartfelt condolences, and I think future holds a lot more promises for days to come. So thank you very much for having me. I know that it's been tough for a lot of us, but we've been trying to kind of do something to make easier, things easier for our investors, for our customers. And Cube has been a very active partner for us. We've been working with them for the last 2 years. We've co-created a lot of things, and what I'm going to present today is something that is kind of path-breaking, and we've got a lot of traction on this particular product. So I'll quickly run past this small presentation that I have. Post that, we can open it up for Q&A. One sec. Okay. Can you see the presentation? All right.
Yeah, we can see your screen.
Okay. All right. So quickly, what Faircent is, it's basically it's a destination or a marketplace where it's an online marketplace where people can come and lend and borrow. Okay, so it's a two-sided retail marketplace, just like an Amazon or a Uber or a Airbnb. It comes from the sharing economy only. Sharing economy is an economy where people are trying to put out their assets, their services, and trying to make money out of it, right? So for example, if you have a car, you attach yourself with Uber and you can make money out of it. If you have a house, a part of the house can be let out and you can make money out of it. Airbnb does that for us. So similarly, if you have money, you let that out to people who need money, and you make money out of the money that you lent out. So that's pretty much the model of sharing economies. It has been seen that sharing economy is disrupting a lot of businesses, a lot of marketplaces, especially the incumbents. They're having a lot of problem with these kind of where customers are joining hands. End to customers are joining hands. So we are seeing a lot of reinvention of models, business models, and it's here to stay. It's growing at a phenomenal pace. And the P2P business, or for that matter, marketplace business, which is driven by people, it's phenomenally growing globally. It's close to $350 billion and growing at a rate of 50 to 80% annually. It's pegged to be the fastest BFSI, category, which with the pace it's growing. Okay, so it's huge. So lending has a new definition now. So people are moving and trying to kind of lend money through these models. So instead of banks lending, for example, in UK, US, retail banking has come to a kind of a more or less a halt. So large corporates, banking professionals have gone on record saying that retail banking has kind of completely slowed down or died, primarily because of these kind of marketplace models which have existed, right? So in India, this got regulated 2-3 years back. We were the first one to get regulated, and there was a huge gap of close to 6-8 months before they gave out the second license, right? So because we've been doing this for some time, we've been doing this for the last 7-8 years, and we've been peddling this very slowly initially. And and we're also talking to RBI. And once the regulation came about, it was pretty much the way we thought it should. And since then, we've been peddling a little, more aggressively, right? So that we exactly know now where to go to. So that's the reason we are able to kind of, get this a scale. In the last 2-3 years, we built a lot of scale around this, right? Clearly, this destination is the cheaper source of credit for individuals and small businesses. There are some, rules and regulations the RBI has laid out in terms of how much one can lend, how much one can, borrow. All of that they have laid out. So from that point of view, it's pretty much guarded. And also, as an organization, we make sure that the mitigation with respect to the risk of lending on these platforms, or at least Faircent, is mitigated to quite an extent, right? So why this is cheaper? At times it's cheaper than a bank, primarily because people are directly giving money to people. So for example, a bank customer comes onto a platform, and kind of a customer, a very good customer comes onto a platform. He can get an unsecured personal loan as low as 10%, which is not heard of. Even HDFC can't match that. So it's genuinely a cheaper source of capital, and we cut cost at every level. For example, a credit card customer who's at, let's say, wants to kind of refinance his, the debt. Typically, banks, don't do that, right? And if you roll that, banks typically charge close to 50%. So if you want to settle that and take a loan out of it and settle the bank or the credit card company with that money, you get at Faircent around 20-24%. So you see that it kind of takes care of every type of customer or borrower. For him, whatever the alternative is, this becomes the cheaper source of alternative to kind of come and take a loan. Right? The platform is very fair and transparent. The app is in with people, just like an Amazon or Uber. You exactly get to see everything on the app, and it's very, very transparent. And you make a decision with respect to that. Basically, we say that the power is in the hands of people, right? So we've kind of given at that level. We are a completely tech-based platform. We pull a lot of APIs from various organizations to validate borrowers. This is typically done to ensure that whatever that the borrower is saying or giving us is true, and it's not whatever that he wants to kind of give us, and we make a decision basis that. Okay. So we don't make decisions basis whatever the customer gives. All the data that the customer gives, including his name, including his PAN card, everything is validated through third-party APIs. And if there is any mismatch, the borrower gets rejected. So also, there is a lot of analytics which goes behind all these data points which we pick up on our journey with the customer, which decides in future who are the customer that I should actually go and make live on the platform. So it's a tech-based analytical data science kind of a platform. We also have a lot of partnerships both on the lending and the borrowing side. Cube happens to be one of them. They are one of the large partners that we have. We have hundreds of partners like this on the borrowing side also. A lot of borrowers come onto the platform. A lot of partners come onto the platform with their borrowers, to kind of lend, to their customers. Right? For example, Myntra wants to kind of lend to their merchants, right? So they come onto the platform, they have a partnership with us, and it kind of push money to the Myntra customers. So similarly, we have a lot of partnership like this. Either directly, they get the customers to us, or through some business what they are conducting. For example, MobiKwik gets their customers. onto our platform. So it depends on what kind of relationship that we have with the partner. We have a lot of partnerships going. So that's pretty much what Faircent is. So we are now currently doing 120 crores a month. We've done till now 2,500 crores of disbursement. We have processed more than 25 lakh customers. So this is a little dated. So we do close to 75,000 customers a month. Mostly it is micro SME borrowers, a large number of people in India. There are 60 million micro SMEs in this country. A lot of them do not get access to credit, and there are a lot of good customers out there to kind of reach out and through tech and make them make credit available to them. We have 2.5 lakh individual lenders. These are people like you and me, come onto the platform and lend. On any given day or a month, we have 25,000 customers active on lending. That particular month on the platform. So we have a 10 to 12% of active lenders every time on our platform who come and lend on the platform. Right? We believe that we have 75% of the market share, and it's funny because internet behaves like that. If you are a market leader, you tend to kind of occupy that space. It's very difficult to kind of gain market share once you have occupied, because if you see any of the businesses, any other business, for example, shopping or car hailing or travel or any business, you see market leader occupies more than 50% market share, and there aren't any more than 4 players in any category. So this also we will see that happening as we go along. In the next 5-7 years, you will see that very few players will be there. And we, being the market leader and got the lead of occupying a large chunk of market, seems unless we do something really stupid, I think we'll continue to kind of have that dominant market share. We have disbursed close to 250,000 loans in the last 12 months in spite of pandemic, which amounts to around 25,000 loans a month. So typically we disburse close to 1,000 loans a day. That's the kind of volume that we do, and these are all small ticket loans. This could be as small as 30,000 rupees and as high as 10 lakh rupees. That's the maximum that we can lend on the platform. And we also have a lot of, I talked about lending partners and borrowing partners, right from large organizations like Cube, ICICI Securities, JM Financial, going down to small boutique firms, which have just one person managing, maybe 100, 200 clients. So we have various, lending partners who come and bring in the customers to us. So I think this is one of the questions that a lot of people would have in their mind. I'll quickly try and cover this. How is it that we are mitigating risk for our lenders, right, or for our investors? So we look at the borrowers very, very closely. The borrower is digitally onboarded, and when he is on the platform or on the app, comes out his age, income, location, employment, all of that is validated. A whole lot of rejection in this entire cycle. A whole lot of rejection happens. So the journey starts with initial selection, and after that there is a segmentation process which happens at the bureau end. We kind of try to kind of figure out deep bureau analytics and do the analysis basis the bureau information and exclude all the bad ones. And we have a multi-bureau approach. We don't rely on one bureau. There are sometimes lag in bureau reporting. That's the reason we use multi-bureau to kind of get that segmentation going. Once the segmentation is done, we are sure about who you want to kind of take. For example, a customer who has not paid a loan in the past, will not come onto the platform. Someone who has a CIBIL score less than, let's say, 600 or 650 will not come onto the platform. Certain rules are put, and basis that the customer gets knocked off. Close to 80% of the customer gets knocked off here, and then it kind of moves to the rule engine. A rule engine is nothing but a tech platform which gives you basically a scoring mechanism where there are some 200 variables, and those parameters are broken up into further 3-4 parameters, and all this data kind of moves through these rules, and a score is determined out of this rule engine. So basically the score is nothing but it tells me how much of money that I can give, at what rate, and what's the tenure that I should fix. So that's what this the output of this rule engine is. Now the important thing to know about the rule engine is that the rule engine is something which has to be matured over a period of time, and we as an organization have kind of had that luxury of being around for the last 7-8 years. So rule engine is very mature. The predictability and the accuracy level at which this operates is pretty good, and that's the reason I think most of the loans that we predict more or less is, in spite of the pandemic and all. I'll talk about that later. It's coming to be as we predicted, right? So it's a lot of analytics, lot of data crunching, lot of science goes into this. On a quarterly basis, this goes we figure out and understand what to correct, what not to who to give, who not to give, what metric to take, what metric to dilute, what are the variables to increase little. A lot of things happen here, right? So this is actually the secret sauce, if you ask me, of the organization. And this keeps the lenders happy. This keeps Faircent happy, and also the borrower is happy, because if you price the borrower a little higher than what is required, he leaves, right? So it's important to price him right. Only then the customer stays. Otherwise, he has plenty of options. After that, once he passed through the rule engine, there are a lot of mitigations that we do, risk mitigations. There are a lot of APIs through which we check. These are all paid APIs. We check the identity, we check the contactability, we check the employment by EPF data. We have a bank statement analysis, whether there is any fraud or anything that the customer has done. We also look at the propensity and the prosperity and the influence level. So we look at a lot of these are some of the validation checks that I wrote here. We look at a lot of validation checks to figure out whether the customer that we're talking to or the customer that we're taking forward is a customer that we want to onboard on the platform, right? Once that validation happens, and there is a lot of customers who get knocked off at every stage. It's just I'm just saying this. Doesn't mean that all of them go through. So basically, if 100 customer gets in, only 5 or 6 of them get out of the entire process, right? So it's a highly curated marketplace. Once this mitigation happens, it moves to the final approval stage, where the video verification happens. And the lat long, liveliness, all of that is checked. References are picked. And the beauty about this is that we do video verification and use face matching technology to figure out whether the customer that we're talking to is the same customer who started the journey with, right? So when he starts his journey, he has to give some of the documents, which is the Aadhaar or a PAN or whatever. And the image of that is matched with the selfie that he has to take while the verification is happening, right? So there's image matching technology which happens, which tells us whether the customer is the same customer that we have started the journey with, are we talking to, right? Also, he's expected to move around in his house, show his house, show his kitchen, show his drawing room, living room, all of that he has to show for us to get a sense whether the customer is okay or not, right? A kitchen talks a lot. So, if it's a loaded kitchen, the customer is going to be there for some time. If it is not, chances are that he's going to go to school soon. So the verifier asks a lot of questions basis that, he approves that. And once that approval happens, we do a penny check. The customer's bank account is the same bank account that he has started the journey with, or his wife's bank account or somebody else's bank account. We're very sure about that as well. Once that happens, we move the money. So that's pretty much the process. So at an organization level, we do a lot to ensure the mix and the mitigation of the risk happens, so that we are able to make sure the lender's money is protected, well protected, right? So one of the things that we do is that we have different kinds of products, right? So that's one mitigation, so we have a short-term product, we have a long-term product, or products, starting range from 1 day to 36 months, right? So a lot of product offerings are there, which makes it very exciting for the lenders, right? Similarly, the interest rates available for the lenders is, from 10% going up to 36%, okay? And we also cut across loans from different cities. There are 600 cities that we offer loans, business as well as salary. We are not concentrated on one particular city, and this is by design, because it's important. Any particular city that you concentrate on if that city goes bad, your portfolio goes for a toss, right? So we've seen that with a lot of companies, in the COVID, Bombay not doing well, and the portfolio was limited to Bombay and Pune. Both cities are not doing well, and we saw a lot of casualties there and customers slowing down. So ours goes out to tier 2, tier 3 cities, which helps, because that distributes that your money beautifully, right? So that we have a beautiful distribution mechanism there. So just tell you a data point. The largest city that we operate out of is Bangalore, and Bangalore contributes just 3% of the total pie, right? So you can imagine how thinly we are spread. So we also are not focused on a particular type of industry. Okay, so we cut across various industry, be it consumer, microfinance. We do a lot of microfinance loans, medical loans, business loan, education loans, so different kinds of loans. So we don't And most of these loans happen through partnerships, and we are not, fixated on one particular type of partner or one type of an industry, because it's important to kind of, sometimes some industry go bad, some industry is working fine. So we want to kind of be a pure horizontal, so that we kind of take in all kinds of customers to kind of make this a distributed kind of, from a risk point of view. We also take, captive loans from large organizations, which I talked about. And we don't build a lot of dependency here. Just because they are large doesn't mean that I have to build dependency. A lot of organizations do that. We don't do that. For example, if MobiKwik is, having a relationship with me, I don't open up my entire book 50% to MobiKwik. It does not go more than 5-7%. So any large organization's partnership will not go more than 5-7%. So that's the way we have done it. Fractionalization is another thing which we do. This is very, very interesting. Technology does this for you. So for example, if you need, someone needs ₹1,00,000 and you as an investor or a lender getting in with ₹1,00,000, you don't give ₹1,00,000 to, that individual. You just give him ₹100 or ₹200. So your money is broken up into, a lot of units, and you pick up, 100, 200, 300, depending upon, the size at which the fractions is happening. As I said, we onboard 1,000, borrowers a day. So your money is distributed to practically many borrowers, and thereby mitigates your risk, beautifully. So this I talked about. So we do curation, we do data validation. There is a risk person, there is a risk team. They kind of do a manual check as well, do telephonic conversation with the customer. A ticket size which is beyond 5,00,000 rupees, we do physical verification. And all of this is, once this is done, we take the customer live on the platform, and we show that with full transparency. Once that, the customer is 100% funded, a loan agreement gets initiated. The agreement again is, initiated online. And once this happens, the movement of money from your escrow account, so everybody gets an escrow account, and from that escrow account, the money moves out to the borrower's escrow account, and from there to borrower's account, right? So this escrow account is what the RBI had, put out in the regulation. This is a very beautiful system. So basically, I don't have any control on this particular account. This account is managed by a trustee, right? So I just take this instruction of my lenders or my investors to the trustee. Trustee is the one who instructs the bank, okay, and then the money moves. So it's it's not that on my instruction the bank moves the money. So it's not a regular escrow account. It's an escrow account with a trustee sitting on top of it, right? So it's pretty tightly managed. So it's, if you look at it technically, this is like a deposit, right? The money that I get into to the escrow account is like a deposit, and we are not a deposit-seeking NBFC technically, right? But in all practical purpose, this is it's coming as a deposit, and from this deposit is what you're putting it out to the borrowers, right? So the trustee is the one who manages money which comes into the escrow account, right? So that's a beautiful thing that RBI has put out. And which pretty much is protected. Your money is protected, not going anywhere. It moves from that particular escrow account to the borrowers, to the borrower, and from there the borrower is stitched with the agreement, and he's supposed to kind of pay back that money on a regular basis, and this money comes back to this particular escrow account, and comes back to your personal account. So that's the way it works. We also have, full-fledged collection agencies. Sorry, collection as an organization. We're spinning it off as a separate unit. We are also wanting to kind of give that as a service to other financial services companies who are in this business, right? So we use a lot of technology, analytics, data science, and collection as well, right? So we look at to figure out propensity to kind of pay, early warnings, all of that we look at. Before on a regular basis of all the customers that get onboard on our platform. Okay, now so one of the things that you have to understand is that we talked about when you ₹1,00,000 that you pick, you have to pick so many borrowers. Now technically sometimes it becomes very difficult to kind of pick a borrower, so that's the reason we use technology there as well. So you don't have to manually pick them up. Of course, you have a choice to kind of manually pick them up also. But the Cube's journey is that we are using a lot of technology to kind of bring that at ease for you guys, right? So this is the way it works. If you have to kind of make money, if you're investing in low risk, you pick up 100 borrowers, you'll make 10%. In the medium risk, if you pick up 1,000 borrowers, you'll make 11.4%. As you go along at a very high risk, 24% above, you have to pick up 1,00,000 of borrowers to make 14%, right? Now, if you look at it on the left side, as the risk climbs from 10% to 24%, your average return does not climb the same way, right? Okay, so there is a difference of 10% if you see in the very high risk, and that's how risk behaves. The risk moves geometrically as you climb, but your returns, don't, right? So returns kind of muted, right? So that's the way it works. So if you have to make at a very high risk, you have to pick up a lakh of borrowers, and that's not possible because regulation has a limitation of 50 lakh rupees. So you can't invest and also manually to kind of pick up a lakh of borrowers becomes a challenge, right? And that's where Cube and Faircent decided to kind of create this product, which is the SIGP. So SIGP is nothing but systematic income generation plan. So what it does is that it offers a non-volatile, stable returns to the lenders, right? It's a completely analytical-based program. We leverage a lot of data, a lot of analytics to kind of weave this for Cube. This completely reduces the spending time to pick borrowers for the lenders, and also for the borrowers, it solves the problem of getting money quickly, right? So the way it works is that the money is pooled, and it's put out to the borrowers who come onto the platform. So whatever returns that you get out of that borrowers, equally is distributed to the lender. So nobody gets a very high return, or nobody gets a very low return, or go into losses, right? So it's a stable return, and currently we are offering a return of 12%. This is flat return. So, for example, if you put a lakh of rupees, you'll get a lakh and 12,000 rupees at the end of the year. So there are two options there: 6 months and 12 months. 6 month option is 11%. 12-month option is 12% return. So you get your return, principal and the interest at the end of the tenure, and there is no processing fee here. So this is just a representation of the same thing. So you put 10 lakh rupees, there is 6 months and 1 year. The interest that is offered here is 11% annualized. Here is 12%. The gross return that you'll make is 7.3% and 15.64. I'm saying after putting it on all borrowers, let's say I'm making 15.64%. There is no fee for the lenders on this. Let's say default is X percentage, whatever that X percentage minus, the 12% is given back to the lender. So whatever is beyond 12%, Faircent will retain, and whatever is up to 12%, let's say if I only make 12%, all of it goes to the lender. If I make 11%, all of it goes to the lender, right? So this is how it works, and how we ensure that we are able to kind of give returns. One, we are kind of looking at the portfolio very conservatively. We're building it out very conservative approach, 700 plus CIBIL, all of that. Plus, we talked about the diversification across all segments. The mix of borrowers that we are doing is pretty good. We are also closely monitoring each and every account through various data sources. If any source is not performing, we'll kind of weed that out, that particular source. We get a new source, or we'll enhance the ones which are doing better, right? The collection also will be led by analytics. All the customers who are onboarding on the SIGP is kind of looked at analytically. We look at to kind of figure out whether the payment behavior, are he's paying other agencies or not, other NBFCs and banks or not, or he's just paying us, right? So if he's doing that, chances are he'll stop paying us as well. So it's very important to kind of go and see his data all the time. How is he behaving on the bureau? Is the CIBIL score going up, or whatever score is going up, score is going down? Has his credit card spends gone down or gone up? So has he bought another credit card? Has he taken another loan? So all of this puts stress on my loan amount that I've given. So I need to kind of prioritize who to talk to, who to put pressure on basis that, right? So a whole lot of analytics goes to kind of figure that out. We also calibrate the portfolio on a time to time basis. If there is any portfolio mix within the mix is not doing good, we'll completely maybe take that off, and that's a huge chunk if it has to go. So, for example, we cut out a lot of businesses after COVID happened. For example, hospitality, travel, a whole lot of restaurant business. All these businesses we kind of had cut out once the COVID hit. So a lot of big chunks of portfolio gets knocked off, recalibrate on a time-to-time basis in this, right? We also have a philosophy in this that if we make money out of the high interest rate borrowers, that money will go to lower risk, riskier, borrowers. So we will not get greedy. At least in the first few years, we will not get greedy. We'll kind of make the portfolio solid so that it starts to kind of do well, right? We also manage the portfolio with the risk and tenure, right? So it's important to realize that if I'm promising you six months and 12 months, I should not be lending long term. If I lend long term and promise you a short term return, that's not done, right? So I have to my mixed portfolio has to be pretty well. It has to be tenure wise. I have to manage that, and also risk wise. I cannot, if I'm promising you 12%, I cannot be lending out at 10%, right? So I need to kind of manage that with risk and also with tenure. It's important for me to kind of ensure that happens, right? So quickly, so this is for the benefit of people who have already invested in SIGP. A lot of Cube investors have invested in SIGP. So this is how it has, progressed. We just started, this is around, after the first wave is when we started this program. We started small, we started very muted. It has gone out to only select partners. It's not opened up. If you go to faircent.com homepage, you will not see this. So this is very, program only limited to very few partners, and so if you see till March, we had kind of scaled to around 8 crores, and then April the COVID happened. It kind of came down a little, May further down. So this month again looks back. It's coming back to the level of April. I think from July onwards, this will get back to kind of maybe 10 crores. Okay, so there is a lot of demand which is there of the money which is there. The borrower flow has dropped. That's the reason this money has dropped. It's not that the lenders have stopped. There's a lot of demand for this product in the market. We are not able to kind of handle it because of the consumption within the borrowers have drastically dropped, right? And people don't need a loan right now. Good borrowers I'm talking about, right? So that is picking up now. We are seeing some trends that's being picking up this month, and from next month I think this will get normalized, and this July, August, September quarter should be a good quarter for SIGP. So this is the channel-wise mix. We have a lot of programs. There's a pre-approved program. There's a lot of partners that we run. We also work with a lot of payment companies, which you talked about, wallet companies, MobiKwik. We also work with Eco, Pay1, Oxygen, all these guys we work with. We get direct customers also. This is organic, and we also work with a lot of third-party customers who give us the data. For example, Paisa Bazaar, Bank Bazaar, all these guys, India Lens, all these guys, we get a lot of. This is a portfolio mix with respect to the return, ROI. If you see, we have marginally improved the ROI to 13.07, and this is how the mix is. And if you see, when we started, most of it was sitting in 10 to 12%, and it's kind of moving towards this side, if you see. And that's how we're going to build this, because it's important to kind of ensure that we are able to kind of give returns. So why this is happening is because initially we have to look at data, understand, move, understand, and that's how it happens. You have to calibrate and kind of move. You can't just suddenly put a lot of money to a lot of borrowers and see it all going bad, right? So that's the reason we have been not opened this to the public, to the entire janta. So we've opened it to very few partners, very few customers, so that they all enjoy the returns. Also, we get the learnings in and as we go along, right? Okay, so this is the tenure breakup. If you see, a majority of them are sitting between 18 to 24 months. Okay, so which means that now, why is it that I'm promising a 12% return, but I am lending it out to 24 to 18%? So this is the fundamental base that I'm making, right? Any customer who takes a long-term loan is a good customer, a solid customer, right? Short-term loan guys are another ones who are not good customers, right? So or the ability to kind of pay is more with these guys who have a long term, right? And the data suggests that people who can pay for long term, who come from a particular background or the business or whatever, has to kind of have that, right? So that's the reason you have to create a base, and on top of that you have to create the model, right? So those things are happening right now. 0 to 6 months is what we're focusing right now. We don't want to expose ourselves a lot at this point in time during COVID, giving out long term loans. So the mix kind of gets changed as we go along. And the returns. We've already started giving out returns to our lenders, in fact, because 6 months, a lot of people had invested. October, we had started last year. So the lot of customers had completed the 6 months. So that journey is. So yeah, so that's pretty much the breakup. This is the bureau score and the ticket size averages. So we're currently hovering around, average credit score is around 693, and the split between salaried and self-employed is 63 in favor of self-employed. So we get a lot of self-employed people coming and taking loan from us. And self-employed guys are better than it's very predictable, better than the salaried guys. It's very predictable. You can see the business very cleanly, but a salaried customer is very difficult to kind of figure out, because whether he's going to be there in that job or not be there in the job, the business itself will be there or not. So all that is very difficult to predict, right? But in a self-employed, it's very relatively simple and easy to predict. He'll be in some green field, some kind of a business which has been going on for donkey years. We can predict the from his cash flow how long and how well he is doing. And the ticket size around a little less than 2 lakh rupees at this point in time. And as we go along, this ticket size will also kind of drop, because we've changed a little bit of tenure as well as the risk right now. So this is the gender attribute. Typically, majority of them would be, because it's skewed more towards the self-professionals. So majority of them are between 30 to 40. Majority of them are male, and majority of them are graduate. And I talked about the split between salaried and self-employed. Geographically, we are pretty much dispersed across India, and this is how we do it. And this is the best way to do it. If you are, if you look at banks, they also have branches. See, within Delhi also they would have multiple branches, so they cut across entire India. So distribution, financial services have to be distributed well, otherwise it doesn't work, right? So people who are concentrated and you're not using technology are the ones who say that I'll only kind of the process in Mumbai and figure out, understand, get better, and then kind of move to other cities. It's bullshit, right? If you want to do a business in financial services, you've got to be distributed, because the local dynamics is completely different, right? So you never know what happens. For example, microfinance companies, when they are going to kind of rural areas to kind of underwrite loans to end users, they don't underwrite individuals first. They first underwrite the region. Is there any mafia there? Is there any badmash there who's going to come and say that, or any neta there who's going to come and say, "Kal ko loan dena nahi hai aapko, aapko paisa wapas dene ki zarurat nahi hai." If he comes and says something like that, your money is stuck, right? So if you have exposed yourself a lot there, you're stuck. So that's the reason it's important to kind of spread yourself. So geographically, we kind of. So this is how a typical salary border looks like. 31-year-old staying in, this is just an example. The guy has paid, or he's been paying well. And this is how a self-employed guy looks like. Now, a salaried guy may still get a loan from a bank or an NBFC, a large NBFC, but these guys find it very difficult, right? And there are so many of them, so many good customers out there who are doing genuine good business and validated from all kinds of data to figure out his real cash flows and all that, and they're waiting for people to kind of come to them and kind of give money. So he's in the business of trading of cattle feed, right? It's an evergreen business. It's never going to go out of fashion, right? So and there is nobody, no bank, nobody is wanting to kind of lend him. We get a lot of customers like this. Okay, so this is how the return looks like. So this 12% band line that you see is what we are promising to our lenders, and and this is the month-wise progress. And if you see this, gap which has come about right now, is primarily because of the COVID. We saw a dip in the 90 plus 0.36. But in the last month, we have improved by 0.04 bips. So basically what it means is that we've stabilized it. I think from here on, we'll only kind of go up. But having said that, we are still seeing some, COVID impact. This number looks like will go up to 1%. We had factored 2%, 2.5% in this entire model. So we are still better off. And we are going to move this tenure and the risk a little bit so that we are able to kind of make sure that we are staying away from this line, this 12% line, so that we are able to kind of return lenders the money. because whatever that we're going to make is going to be this, right? So otherwise we don't make money. So it's important for us to kind of, we have put our neck out to kind of make sure that we are making money out of this. And this whatever 12% that we have put out here is a study of last 8 years. We have kind of given out these kind of returns to our lenders. We looked at aggregated data to kind of figure out this is the return that we are able to give to the lenders, and that's the reason we said that we'll be able to give. And 12% is a decent return, mind you. Okay, and we said that we'll be able to make a couple of percentage on top of it. Let's see how it goes, right? So we're not anticipating second wave come to kind of hit us so bad, but still, you know, the portfolio is doing well, really well. In fact, we kind of improved if you look at it. This is how it looks like, the collection. So it is. This is till 24th May. And obviously this would have improved a little bit more because last few days really kind of, guys slog it out to kind of get the money out. So it was at 96%, which is 0 to 30. So if you look at this, this is the percentage wise, if you look at it, and this is the amount wise. So if you see, this is the breakup. So 2.57 is the one which is 30 to 60. And there is 0.59 at 60 to 90, and 90 plus is 0.7 in terms of count, and 0.36 in terms of value. That's it. So I think that's about it. So I'm open to kind of if you guys have any questions. So this is just a slide which talks about some of the awards and stuff that we won. One of them was a prestigious one, which is Interbrand Award, which gets to very few people. We are one of them. This is basically an award by New York Stock Exchange, which is in collaboration with Facebook and I think another company. I'm forgetting the company. So Interbrand, yeah, that's a brand. Interbrand, Facebook, and New York Exchange, come together and kind of give out this award. So we won this a couple of 2-3 years back. They pick up randomly. They don't kind of interview or they kind of do. They just do some survey and all that, and they pick up 2 brands out of India and across the world. They pick up a couple of brands. So 2 brands that year which got picked up was Zomato and Faircent. There are 2 brands that picked up, primarily because the way we do this, right? So they were pretty excited about, I think, the way. Rest we've been, we've won a lot of, what do you call the reality shows in the startup, which happens early days. We also had one case study going with I Am Bangalore, which is in the Harvard Business Review. It's a paid case study. You have to pay $8.95 to kind of get that going. So this is a very good exercise that we did. So they came to us primarily because they said that genuine marketplace in the financial services business only you guys are doing. We're two-sided, large number of customers, only you guys are doing. We want to do a case study on this. So nobody else is doing the fintech play. If you look at the lending business, right? Nobody is doing, right? So they would have NBFCs on one side, 5, 6, 7 NBFCs on one side. On the other side, they'll have lots of customers, borrowers. It's not a two-sided marketplace. A classical two-sided marketplace is when you have lots of customers on both sides, right? Like an Amazon or Uber or Okay, so these are investor advisor. Mohandas is an advisor, and we have some angel investors. We have some of the marquee investors who have put money on Faircent. We have JM, we have Muthoot, we have ICICI Bank, and this gives us a validation with respect to whatever that we're doing. We're doing it right. We're doing it, and they're all interested, all excited about what we're doing. Right? A lot of Japanese investors. It's very difficult to get Japanese money. So a bunch of Japanese guys here. Mohandas Pi's fund is also here. There's a Belgium-based fund also who's invested in us. So Das Capital, Stavo Asia, and Gosini Capital. These are all Japanese guys. This is a US-based fund. Yeah, that's it. Thank you. So happy to kind of take questions.
Yeah, that's awesome, Vinay. I think I love the depth with which you covered this and the transparency it brings to the whole picture. I'm a little concerned about Gaurav because I think you may have already answered so many of the questions he had picked up from the audience. Gaurav, do you want to just take over and ask some of the questions if there's anything that Vinay hasn't covered?
Yeah, hi. Thanks, Rishabh. Thanks a lot, Vinay. Good morning, everyone. Yeah, you're right. Vinay has, very, in quite much detail has covered pretty much everything. But let me just add a few things. This is, as Vinay said, right, this is one of the offering, this SIGP one specifically, which, we have been very excited about. for multiple reasons. This is the feedback we have been getting from our users from last 2 years of partnership, that they're looking for a simpler product. Simpler in their definition is if it can be short tenure, could be 6 months, 1 year, etc., and it could be indicative yield product, for example. Now, SIGP specifically, ticks both these boxes, and hence, I am not surprised that we have seen extreme excitement as well as investments from our current base already, and we are looking forward for more, right? There are areas where people have asked us question, and Vinay has again covered them really well, whether they are from how they go about select the borrowers, right? What is the product mix in terms of salaried versus non-salaried, whether pool loans versus others, etc., right? The areas about risk mitigation, how does it work in terms of structure, what is it in terms of liquidity lock-in. I think pretty much everything has been covered, right? One thing, the only question I have, which is open right now, is that what holds in the future, right? Are there more products lined up, whether it's liquid, 0, 3 months, 18 months, whatever? And then we can almost open the floor, Rishabh, for everybody to ask questions.
So you can expect a lot of variants of this particular product. So one, clearly we will be launching a 24-month and a 36-month product, apart from but those will have a lesser rate of interest. I don't think so. For 24 months, 12% is a crazy return, right? So also 36 months. So I think that will have a lesser rate of interest. We will also try and get a 3-month product as well, right? So we're looking at that. So that'll take a couple of quarters to kind of come about. And I think by next financial year, we are wanting to launch a product which will have a liquidity of 48 hours, right? 48 hours liquidity, you can have a product, but the returns there will be really less, right? But definitely better than a bank would offer. But the liquidity, from a liquidity point of view, you can get a liquidity within 24 or 48 hours. I think it'll be 48 hours, not 24 hours, because we rely on the banking infrastructure to kind of give liquidity. So at times they kind of have a lot of delay. So apart from that, I think we should be able to kind of give that out to our lenders. Yeah. So those are the variants. So another variant that we will bring about is that you invest and you just take interest on a monthly basis, right? So rather than you're getting return at the end of the month, end of the year, you can kind of park the money and just get the interest out of every month. So,
Yeah.
so that's another product that we might.
Perfect. So I'll pick only few more questions, and I'm just going to the list I already had, and then I can let everyone else ask the question. See, the first question, Vinay, I have is this. In extremely simple way, from almost like a user side, I imagine this product like a 11% or 12% product, depending on the tenure, right? So what I'm interested in is that what's, let's say, the current return right now, okay, so that I am a little bit assured that I'm going to get 11 or 12%. Second is, whatever is the returns, you might have also be calculating your NPAs on the real-time basis, right? So again, it gives me the comfort to say, I'm going to get my 11 or 12% back. Can you throw a little bit of light on that?
Yeah. So the chart that I showed you of the graph where we are making around 13 point. That's the real-time data that we have. So it would have slightly gone better from whatever that graph is. So that's, see, you have to understand the way risk works, right? So it's not going to, so these are good qualified borrowers, right? We look at a lot of data to kind of bring these guys in. So it's not that we're just blindly kind of getting these guys in. So it's going to drop. It's not like a payday loan, right? You kind of spray and pray wala model nahi hai. So we are looking at a lot of data to kind of get these guys in, right? So it's not going to drop drastically. So the target or the tasking to the risk is not basis on these percentage. The way it happens is that, for example, we were expecting, let's say 14%. It's let's say sitting at 13.08 whatever percent. So there is 1% drop. But if you look at it from the risk point of view, if it was, let's say 13.5 earlier and it has come down to 13%, which is a 100% drop, correct? From the 14% if you look at it. So the risk does not kind of move that way. So if you look, if it kind of comes down to, let's say 12%, that's some 300% or a 400% drop, right? So it does not drop that bad, right? Because if you look at, unless something completely catastrophic happens, macroeconomics kind of play out. But that's not the case. I think COVID, people got inside and they're all coming back. They're all kind of coming back to work. So this is going to be maybe a little cyclical, but people will kind of get accustomed to this, and people will kind of the next 3 months, all of them will go out and make lots of money, right? Maybe the third wave or whatever is going to come, they'll sit for another couple of days at home and they'll come back again and make money. So that pattern may emerge for some time. But people will, generally kind of make money and kind of. So these are all qualified. So our bureau vintage is 2 years, right? Anybody who's not been in the bureau for the last 2 years, we're not taking those guys in. In fact, in some cases, we're looking at 3 years bureau vintage. Now, what it means is that in the last 3 years, you should have been or more, and whatever time period you have been, you should have never defaulted, right? You also, there are rules about delays. If you have delayed more than 2 or 3 times, also in the last 30 days or last 1 year or last 2 years, you'll get knocked off the platform. So there are stiff rules there, which the customer gets in. So it's not that we're just pouring in people, and that's the reason I said the demand is very muted right now, because we're not generally trying to kind of, and there's a lot of lender money lying. So there are some 19 crores lying with us right now, not able to debut primarily because the borrower flow is not coming. But we know that borrowers will pick up from next month. And this 19 crore can get deployed in 10 days. And if you move to a shorter tenure loan, and shorter tenure loan commands a little bit higher interest rates, and if you can move the interest band from right now from 13, 14 or whatever percentage to some 16, 17%, we'll be able to kind of cover that gap or whatever that.
Got it. Makes sense. So
interesting. And also just jump in and tell everyone that if you guys have any questions, you can send them via chat directly to Gaurav, and he can post them for you. And you can also raise your hands if you'd like to just come on, I can unmute you and you can ask questions as well.
Yeah. So I'm just addressing Sanket's question. Sanket, I hope this answers your question, because this is exactly I wanted to know. If we are offering 12, what is it at we are currently? That almost covers everything else. It's currently above 13. So, that gives us a little bit of assurance.
So I'll tell you something very, very interesting. So if you're coming onto the platform directly and picking borrowers, using your intelligence to kind of pick up borrowers, and you don't have the kind of ability to kind of pick large number of borrowers there, right? So you'll be picking 100, 200, 500, maybe 1,000 borrowers at best. But here your money will get exposed to maybe if the portfolio. So for example, right now we have 2,000 borrowers in the portfolio, right? So 1 year from now, it'll be, let's say, 10,000 borrowers in the portfolio. So whatever money that you're going to put, every time any borrower comes, the money is, spreading it out. Your money is spreading to all the borrowers, because the return that you're going to make will be the performance of these borrowers. Okay. So there is no way you lose your money. I can assure you that. It's not, the money is not going to get lost, because nobody is making supernatural money and nobody is going to lose their money. So it's going to be an average return for everybody. So let's say, for example, if something really bad happens, the third wave is really bad, and that's the only thing that I see at a macro level, which can hurt us. And if it kind of comes down, where a lot of jobs are lost, a lot of people are unemployed, all of that happens. And let's say that it can come down from 8, let's say 12% to 8%, let's say, okay. But with such macroeconomic spring, all that 8% will come to you, to the lenders. So the money will not be lost. That is, at least we are very confident on that.
Right. So a related question, Vinay, and Nivesh has actually asked this question. If you can help understand, how does this work? Because if I put in money, it goes to a specific set of lenders. My returns would be directly dependent on that. I'm talking about primarily around SIGP. How does it work?
So the way it works is that, for example, if you put, let's say, a 10 lakh rupees, okay, and there are some 2 borrowers worth 5 lakh rupees each. Maybe your money could go to those 2 borrowers, 5 lakh rupees each, okay. But we have put some rules of more than 50,000 rupees a borrower or per a lender. But the return that you're going to get is not based that. The return that you're going to get is going to be all the 2,500 borrowers on the platform.
Got it.
That's the way it works, right? So it doesn't matter how much money you put, and whichever borrower that is going to, the money that you're going to get will be completely different. No, it'll work as a pool, and whatever return the pool is going to make will come to the lender.
Got it. I know you have already explained this around returns, but maybe it's worth pulling that slide. Nitansh has asked this question. Nitansh Rashogi has asked this question around this 6 month is around 11%, 12 month is around 12%. I think there was a slide you were trying to explain what happens after default, etc. Right, and what
Yeah.
eventually comes to us. Maybe you can pick it up and just throw some more light on that.
Yeah. So that's basically a slide which explains, you know. Yeah, this slide, which basically tells you this is the gross return. This gross return is basis, we are saying, if we're putting out on borrowers and the gross return in 6 months, we're going to make 7.3. This is, as I said, this is 11% is annualized, right? So if you're going to have 6 months, it's going to be 5.5, right? The return that you're going to get, right? Absolute return that you're going to get is 5.5. So on a 5.5, let's say if you're able to make a 7.3 gross return by lending it out to borrowers, we have to expect some default, right? And that default could be, let's say, a couple of percentage or 1%, whatever. So you minus that with that, and you give a 5.5 yield to that. So that's the way it works.
Got it. I'm just quickly skimming through questions because some of these you have already covered. Just give me 1 second. There is a So Nisha has asked a question around risk mitigation, etc. What I can answer on behalf of Faircent also, Nisha, is this: we are primarily focusing a lot on SIGP as this for this webinar specifically, and Vinay has spoken a lot around what the risk mitigation specifically around SIGP, because it is a way more conservative product than any other product which Faircent offers or we might have offered. There is a question from Himanshu. So this question basically is around what happens if the returns go below 12% or example, right? And if there is any almost quote unquote security you get from your partners, which are like a group of pool loan partners.
So we do get, but if you look at these securities have no meaning. Okay, it's just a comforting factor. That's about it, right? So because when it goes bad, it really kind of goes bad and goes bad beyond whatever security that we have. For example, some of these partners that we have, and that's a realization that we had from the last wave of pandemic. We had a partnership with Urban Clap, and some of the borrowers of theirs kind of defaulted, right? So there also we had structured the product in a way that we secure it for our lenders, but it went beyond whatever that amount was, right? So these guys are able to offer you 10% or 15% at best, but they're lending at let's say 100%, covering only 15% of it. Now, if the portfolio goes beyond 15% or 20%, then anyways you lost all your money, right? So it doesn't make sense, right? But what we also do is that ensure that at least if it is a 1 month issue, then it's a different thing, right? But what we realize is that to validate our borrowers yourself, to figure out who should you lend to with the data that you have crunched in the last 8 years is the best way to go about. Okay, and if the macroeconomics or for that matter, so for us to kind of make the mistake, because data will not lie, right? So whatever that we are doing, we're saying that so many thousands of borrowers are paid, and and that's the reason these borrowers are good, right? And we are trying to kind of onboard those borrowers. Now, if everything remains the same, I think these borrowers will perform. If things go bad, then these borrowers will not perform. Now, if they don't perform, if the return comes down, all of that will go to the lenders. So I will not make. So if it is less than 12%, let's say if it is 11.5% or 11% or 10%, all of that goes to the lender. We don't make money. But that will be a news which will be a big news. It will not be a, so there's not be another third wave of COVID. Not kind of we'll manage that also. Don't worry about it, because I don't think the third wave is going to be as bad as what it was the second wave.
Got it. I have unmuted Saurav. Saurav Sharaf, you have a question. You can ask a question if you want. Okay, I'll move on. There's a question of comparison of platforms. I'm specific. I'm not picking up this question because, as I said, this particular session is quite focused not on the overall platform comparison, but specifically around SIGP.
So I can react on that if you
Sure.
want. See, you are free to kind of go to any platform and put money whichever way you want to. But there are only two things that you have to kind of be very careful about. The first thing is that your money is well fractionalized. Okay, it should go to thousands and thousands of borrowers. Otherwise, you're in. So even if you're paying 5,000, 10,000 rupees to a particular borrower, you will make losses. Okay, because these borrowers, even one of them go bad, your principal is not getting knocked off, right? So unless and until your money is getting broken up into 10 rupees, 50 rupees to that extent, only it makes sense. SIGP offers that, program. That is one. Second is the distribution that I talked about. It should be a product or a borrower should be picked up from multiple locations. So COVID is just one example, right? Anything can happen, earthquake can happen, something can happen, so you will completely see the city going under a lot of stress, so none of these borrowers kind of start pay. It's very difficult. So the distribution has to be very, very well done. Also, you have to see whether, the company is going to be there for the next, 2, 3, 4, 5 years, whatever time you want to invest with them. We're backed by a lot of investors. They're not going to let us go very soon. We're going to be here for some time.
Okay. Saurabh, I have unmuted you. You can ask the question.
Yeah. Thank you, Gaurav. Vinay, my question was regarding the point you mentioned. You assured the principal amount at least that will stay secured. So how are you how are you assuring those things, or in case there are
see, the assurance is basis the data. So data that I've looked at in the last 8 years of my lenders coming out of the platform, and a lot of people making money and some of them losing money, right? If I put that on an aggregate level, if I put all of them together and I say, hey, instead of individual people coming and lending money to some of my borrowers, and some of them making a lot of money and some of them making not money, some of them losing money, if I do this together and pull this together and give an aggregate return, all of them would have made some 13, 14%, right? So I have picked up 12%. I'm saying that this is 8 years data. Okay, I've said that I'll promise my lenders 8%, and anything which I make beyond that, I'll keep. Anything which is around 12%, lenders will keep. That confidence is coming from there.
Got it. So, Gaurav, if you can make me the host again.
Yeah, sure.
I think
I was just about to say there are a couple of questions for which I think you have a better surprise than I have. So you can, explain. And there are a few questions we are not able to cover in the interest of time. I'm more than happy you guys share it across and we'll, get you the responses. And any which way we are there. Yeah.
Awesome. Okay. Thank you, Gaurav. And thank you so much, Vinay. I think the session was super duper interesting. Even to me, as someone who's been, reading up on Faircent, we're doing all this content around the product, trying to explain it to the users. And we've got. I was surprised that we got any questions at all after the kind of depth you went into. So, guys, in the interest of time, we'll have to conclude our session right now. If you have any questions that haven't gotten covered, you can always, reach out to us directly or to your wealth coach. And I'd like to end with one piece of good news for everyone who's been thinking about investing in Faircent and has been on the edge, if at all, because for the rest of the month, till the end of June, we've reduced the minimum investment amount for SIGP schemes, so both the SIGP schemes, from 1 lakh to rupees 15,000. And you can go ahead and try that out if it's something that you've been thinking about. Thank you once again for joining us. Thank you so much, Vinay, for joining us today, sharing all these details and giving us your time.
Thank you so much.
And we'll wrap up with that. Everyone, have a good weekend.